Picture this, late 2026. Your phone buzzes in the dead of night, slicing through the silence like a bad omen. You reach for it, eyes half shut, expecting nothing big. But there it is, a fresh Fed alert. Rates slashed again, down to 3.25%. A flicker of hope. After the grind of 2023's 5.5% peak, pinning you under crushing loan payments, this should feel like freedom. You swipe to your banking app, heart quickening. Mortgage refi simulator loads, 5.7% now, shaving hundreds off your monthly hit. But wait, the fine print glitches into focus. Home values surged another 4% this quarter alone. That affordable dream house from January? Now $50,000 out of reach, demand exploding as everyone piles in. Switch tabs to savings, your 5.1% yield from last fall, plummeting to 2.9%. The gains you banked on for that emergency fund, vanishing like smoke. Relief turns to a cold knot in your gut. Lower rates aren't the savior they're cracked up to be. They're a sleight of hand, boosting one pocket while emptying another. And in this game, the house always collects its cut. So ask yourself, in the shadow of falling rates, are you the winner emerging or the mark left holding the bill? Welcome to the understated pivot of 2026's financial landscape. Interest rates, after clawing back from their 2023 highs, are in steady descent. The Fed's target range sits at 3% to 3.25%, with economists at JP Morgan and Goldman Sachs eyeing another quarter-point trim by mid-year. It's a calculated unwind. Inflation tamed to 2.3%, unemployment steady at 4.1%, global tensions easing just enough. But this matters urgently because it's reshaping decisions for 120 million American households. With total debt cresting $19 trillion, credit cards alone up 8% year over year, lower rates dangle as a lifeline for borrowers. Savers, though, they're watching passive income streams dry up. This isn't distant Fed speak. It's your refi math, your CD rollover, your long-game wealth building, all tilting on this axis right as AI job disruptions and election year policies add fresh uncertainty. Let's trace the chain reaction. Core mechanic. The Fed's federal funds rate sets the tone for everything. It drops. Banks borrow overnight at rock-bottom costs, say 3.1% instead of 5.3%. That cascades. For mortgages, the link is the 10-year treasury note, which anticipates Fed moves and inflation paths. Yields there have slid from 4.2% in early 2025 to a projected 3.6% by summer 2026. Mortgage rates, adding a risk premium, follow. From 6.5% averages last year to 5.7% to 5.9% now, per Freddie Mac data. Cash yields mirror this, but inverted. High-yield savings and money markets, once fattened by hikes, deflate as banks pass on lower costs. Step 1. Mortgages under the lens. Envision a couple in Denver pre-approved for $450,000. At 2024's 6.9%, monthly outlay hits $2,965, stretching their $7,000 take-home. Cut to 5.8% in 2026, drops to $2,640, a $325 breather, freeing cash for student loans or kids' tuition. Timeline. Apply now, lock in before summer forecasts push rates sub 5.5%. But here's the pivot. Lower rates ignite buyer frenzy. Inventory tight, per Realtor.com, listings down 15% from pre-pandemic. Prices? Up 4.2% nationally, hotspots like Austin or Miami seeing 6 to 7%. Your savings erodes as bids escalate. Refi an existing $350,000 balance from 7% to 5.8%. Monthly dip of $250, yet origination fees, appraisals, $7,000 average, mean payback in 2.5 years. Miss that window, and rising values lock you out. Flip to cash yields. Savers domain. Mechanism. Banks fund accounts via short-term treasuries and Fed reserves. Rates fall, so do payouts. A $100,000 high-yield saver at 5.2% APY in January 2026 earns $5,200 yearly. By July, at 3.4%, $3,400. CDs offer locks. Grab a 1 year at 4.8% now before it vanishes. But variable accounts adjust weekly, exposing you to the slide. Subtle irony, the Fed cuts to spur spending, but savers hoard harder, wary of thin returns. It's a behavioral loop. Policy aims for growth, yet triggers caution. Now, peel back the uncomfortable math. Mortgages aren't linear. Amortization front-loads interest. On a $400,000 loan at 6%, first-year interest eats $24,000 of payments. Drop to 5%, saves $4,800 annually early on. But factor spreads, lenders pad 1.5 to 2% over treasuries for profit and risk, widened by 2022's volatility. Real rate floor, around 5.3%, not the 4% pipe dream. Lifetime cost, at 6%, $719,000 total paid on $400,000 borrowed. At 5%, $579,000. Huge. Yet affordability crunches. Median home $420,000, median income $78,000, payments devour 32% of gross, per HUD guidelines pushing 28% max. Hidden, private mortgage insurance if down payment under 20%, adding $150 monthly. The system rewards equity-rich refinancers sidelining first-timers. Cash math stings too. Real yields, nominal 3.5% minus 2.3% inflation equals 1.2%. Barely outpacing erosion. Taxes compound, $3,500 interest on $100,000 at 24% bracket, $840 to Uncle Sam, net $2,660. Absurd twist. In a low-rate world, cash feels safe but yields poverty. Compared to stocks, S&P averaging 7 to 8% post-inflation historically, but with volatility that savers flee. The mechanic, opportunity cost. Park $50,000 at 3%, earn $1,500 in a balanced fund, potentially $3,500, but risk a 20% drawdown. Rates lure you into complacency, masking inflation's slow bleed. Contrast the spin. Headlines blare, rates plunge, housing boom ahead. TikTok gurus tout, buy now or regret forever, flashing McMansions. Truth, 70% of flips break even or lose after commissions per core logic. Low rates birthed 2021's mania, homes up 20%, then crashed with hikes. Now with supply chains stabilized but tariffs looming, cuts could reflate assets artificially. Savers get secure your future with 5% yields ads. Reality, those peaks were anomalies. Historical averages hover 2 to 3%. Broader hype, low rates as economic cure-all. But they amplify inequality. Asset owners borrow cheap, invest, compound wealth. Wage earners, stuck chasing yields that fade, zoom out. In 2026, lower rates stabilize post-pandemic wobbles, boost corporate borrowing, up 12% in investments per BEA data. Mortgages unlock mobility, easing labor shortages in growth cities, but perils lurk. Debt addiction, household leverage at 80% of GDP, vulnerable to reversals. If inflation ticks to 3% on supply shocks, Fed hikes back, stranding ARMs at higher resets. Cash dips push retirees into riskier bonds, inflating bubbles. Globally, US cuts pressure emerging markets, spiking their currencies. In an AI era displacing 20% of jobs by 2030 per McKinsey, low rates buy breathing room, but don't build resilience, they mask symptoms, not cure. Quiet humor. We toast falling rates like a bargain basement sale. But the discounts? They're subsidized by your shrinking savings. Classic shell game. Final thought. What if these easing rates aren't the bridge to stability, but a mirage, luring us deeper into dependency? Or is the true edge spotting the shift early before the next hike rewrites the rules entirely? Fade out. Thanks for watching. If this cut through the noise, like and subscribe. See you in the next Unraveling.